Welcome to Investors Insights, where today's topic is higher payouts and lower jobs. I want to start today's vlog first talking about dividends. Obviously, it's a hot topic. We look at total return, not only in equity and bond increases, but also kind of looking at total payouts, income, and dividends. And today I want to focus on the dividend increases we're seeing. Dividend increases remain robust with ample cash on the sidelines by corporations. And as you can see in this chart, the S&P 500 companies continue to deploy some of their cash in the form of dividend payments, with 72 increases and 5 initiations taking place in the third quarter. So for positive dividend actions, this is a marginal quarter-over-quarter increase, but impressive on a year-over-year basis. Also, what we're seeing is aggregate dividends paid are on pace for a record year, despite the dividend yield remaining historically low for the S&P 500 due to the higher stock prices. The aggregate amount of dividends paid is on pace for a record year. As this chart shows, during the first 3 quarters, companies have paid $377 billion, which is only about $108 billion less than the 2019 record. So, historically speaking, the fourth quarter has been the most robust quarter for dividend payments as well. So it could be a record year for dividend payments, which is a great thing in terms of total return for clients. Trey, talk about the conflicting jobs report last week. It's had some good news and negative news on the jobs report.
Yeah, absolutely. Jobs report came out very disappointing. Expectations for 500,000 private sector jobs, non-farm payrolls to be created. Only 194,000 non-farm payrolls came in, so very disappointing. It kind of highlights the separation of corporate America and Wall Street and Main Street, where we're seeing companies have record earnings, record payouts. We're seeing productivity of the overall economy back, but the economy's back with much fewer employees. And so that's where you're seeing that higher profits. The good news of the Labor Department report was that wages are up 4.6% year over year. So the jobs that are being created, the people that are coming back to work, they're getting higher paying jobs. That's part of being more productive. So that is a positive for the economy. But we still have millions of people unemployed compared to where things started before the pandemic. Additionally, one interesting data point that people may have seen over the weekend in news reports was that the unemployment rate actually fell more than expected. And that's not because so many people came back and got jobs. That was more because a lot of people dropped out of the labor force. The way they calculate the labor force, fewer people were considered. And that's largely because a lot of people have been unemployed for so long, they're no longer considered in the labor force. So not necessarily a positive point. So something to look at when you're really digging under the hood. Good news is, though, the way people are getting more money for the jobs they do have, and we are still adding jobs. It's just at a slower pace. Another silver lining is that this slow pace likely causes the Fed to pause any talk of tightening up policy, which is, again, good for the market. So you have an easy Fed, a growing economy, but not an overheated economy, and corporate earnings are higher and dividend payouts are going up. All that's likely positive for the market. May not be good for those that are unemployed, but very positive for investors.
Yeah, and Adam, kind of what Trey's talking about. We're seeing a lot of conflicting economic reports coming out. The market's been kind of jumpy the past couple of weeks. You're seeing big up days, big down days. Talk about the update with technicals.
Yeah, Bobby, and you nailed it. So we talked last week about September and the volatility that kind of continued through the month. We do anticipate that volatility potentially continuing to the end of the year. So, on a week-to-week basis, we like to give a short-term resistance and support level. This time, I want to give an end-of-the-year resistance and support level. So the end-of-the-year resistance level we're looking at is 4,550 with a support level of 4,350. Now, it's important to keep in mind that these resistance and support levels are not something that we're actually aiming at and anticipate getting to, but it is important to say that this could potentially be either the ceiling or the floor for the markets continuing into next year. So that's something we want to keep an eye on, especially with the fundamentals that y'all spoke about. And we want to compare it always back to the technicals to get a good compound research behind us.
Yeah, there's a lot, obviously, what we've been talking about. There's a lot of ups and downs, a lot of conflicting messages here with what's coming out on the economic side, the market side. So if you have any questions about what you're seeing in the market, please don't hesitate to call us. We love to engage with our clients, our business partners. So please call us. Have a great week. Talk to you next week. Thanks.